Hey Bowtie Nation, Joseph Hogue here with what could be the easiest investing video you ever see. Easy because I'm going to show you how to get your entire investment plan in just 3 Fidelity index funds. Everything you need to invest in a stress-free and simple plan of just 3 Fidelity funds. Do not confuse easy with not as good though. In fact, the simple 3 index fund portfolio I'm going to show you in this video would have beaten more than 80% of the professional money managers over the last 10 years with a 13% annualized return. This Fidelity Fund strategy will not only take the guesswork out of investing and beat most fund managers, but is also going to help protect you from some of the worst investing mistakes investors make. We're getting started right now, but first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I want to get started on that list of favorite Fidelity funds, so I'm going to show you how to find these on the Fidelity website and how to combine it with individual stocks later. Understand, I am not receiving any compensation from Fidelity for this video. I just think this is a truth that you need to see as an investor. You can use the same strategy with Vanguard funds, and in fact, I did another video revealing my favorite Vanguard index funds that I'll link to in the description below, so check that out. For our first fund for stock exposure, we have the Fidelity Blue Chip Value ETF, ticker FBCV. Now this fund is a long-term growth ETF, so those of you that want that extra cash flow might also want to add a dividend fund as well, but this invests in the large companies that are well established and well known, really the leaders in the market. The fund combines that with a value tilt, so the companies with cheaper valuations, a theme that has been coming back in favor after years of underperforming growth stocks. Looking at the top 10 here, it's a who's who of large cap bellwether names like Berkshire Hathaway, United Health, Procter & Gamble, and Alphabet. Now this does charge a higher expense ratio at 0.59%, but it's worth it for that 17.7% annual return over the life of the fund. Now if you did want to switch this up for a less expensive fund, you could probably go with the Vanguard Value Index Fund, ticker VTV, which only charges a 0.04 expense ratio, so about 0.5% cheaper. The Fidelity Fund has been worth it over the last 2 years though, beating that Vanguard fund by almost 6%, so earning that higher expense ratio. Finding and comparing the index funds I'll show you in this video is super easy. Just go to the Fidelity Funds website here. First go to Our Site's menu item and make sure that you're in the individual investor site. This is the easiest to use and without a bunch of advisor jargon. You'll find all the Fidelity ETFs under pricing and performance, and you'll want to be using the exchange traded funds here instead of Fidelity mutual funds because they're less expensive and are going to cost you less in taxes. Here on the Fidelity ETF page, you'll want to sort this asset class column because we're going to be picking one fund from each asset: stocks, bonds or fixed income, and real estate. That's going to give you the broadest portfolio diversified across the 3 main asset classes in just 3 funds. Here you can compare the funds by expense ratio, so how much you pay to hold that fund, and by the performance on the next page. I usually use this 10-year performance column to get that long-term performance rather than just how the fund has done over the last year. Now, I'll be the first to admit that the expense ratios on Fidelity really surprised me. With most funds from Vanguard and Schwab down to less than 1/10% on that expense ratio, I was surprised to see Fidelity still charging around 1/3% for most of its funds. There are some here around 0.08%, especially the stock sector funds and the real estate fund I'll highlight, but most of these are quite a bit higher than you'd get through Vanguard. And the difference here is really in the management. So while most fund companies have gone to that passive index model where the fund just follows strict rules for investments, Fidelity is still largely managing its own funds. So when you've got that passive index strategy like Vanguard and like Schwab uses, fees are just going to be lower because you don't need as many portfolio managers or analysts. When you're actively managing your funds, on the other hand, buying and selling to eke out that little bit of higher returns, you're naturally going to have those higher costs, and that's going to come through in those higher expense ratios. As an investor, when you're deciding on an ETF to buy, you just got to remember to compare those funds to find those getting a high enough return to justify the extra expense. And we'll get back to our list of Fidelity funds next, but I also want to get your input on this. Now, I'm using Fidelity here just as an example, but you can use any index fund provider for this strategy. So which do you prefer, Vanguard or Fidelity for your funds? Or one of these other providers like iShares or Global X? Let me know in the comments below, which fund provider do you like best and why? We'll use the Fidelity MSCI Real Estate Index ETF, or ticker FREL, for our real estate exposure. The fund charges a 0.08% expense ratio, which is about the lowest you're going to find with Fidelity, and pays a 2.9% dividend yield. Now, this was really interesting to me that Fidelity is only charging 0.08% on its real estate fund, but then we see the fees on all these other funds are so much higher. It really doesn't make a whole lot of sense, but I think you're going to start to see the company lowering its fees on a lot of these other funds as competition from Vanguard and then Schwab starts to heat up. This Fidelity real estate fund holds shares of 174 companies in that REIT and the property space. It's very similar to the Vanguard REIT fund that we talk about on the channel. That's the ticker VNQ. Now, I like that even the largest holding here is less than 10% of the fund, so no single company really is going to destroy the returns if something happens to it. And against that Vanguard real estate ETF in red here, we do see that Fidelity has been able to beat it over the last 5 years, about 13% to 10.5%. So not a big difference, but that fee difference is marginal between the two, and Fidelity Fund has produced a 5.25% annualized return over the last decade. We've still got one more Fidelity Fund to highlight to complete that portfolio, but I want to show you not only why is this a simple 3-fund portfolio so powerful, but also how to combine it with stocks in a perfect mixed strategy. Nation, one of the biggest lies I saw firsthand in my years working as an equity analyst was how Wall Street tries to convince investors that you have to be picking stocks. And wait here, I realize that makes me sound like the biggest hypocrite on earth because, we love to pick stocks here on the channel, and I'm going to explain why I still pick stocks next. But what the pundits, the experts, and all the analysts won't tell you is that chasing stocks is not the best investing strategy for 99% of the investors out there. It's great for the pundits and the analysts. They collect billions in fees and ad dollars, but all that money is just going to be going from your pocket into theirs. The problem here, besides the fees and the commissions you lose by trading in and out of stocks, is that it sets you up for the worst investing decisions, like short-term thinking and panic selling. You end up jumping in and out of stocks, losing thousands of dollars, and you get nowhere. In fact, researcher Dalbar has been studying investor behavior and returns since 1984, and without fail, the biggest enemy to your returns has been your own investing decisions. Over the last 30 years, the average fund investor has made an annual return of just over 7%, well under the 10.6% return on the overall stock market. Now, that seemingly minor 3% difference would have cost you almost $1.3 million in your portfolio. So the question is, how do you keep yourself from ruining your portfolio? The answer is invest in a simple 3-fund portfolio that invests broadly in these 3 asset classes to get that index return. No more and no less. With just the 3 Fidelity funds in this video, you get broad market returns from stocks, bonds, and real estate. When the economy is good, your stocks and real estate jump ahead. When the economy is bad, your bonds protect part of your money. When inflation booms higher, your real estate fund helps keep you up. But then back to that hypocrite part. If the easy fund portfolio is really the best for returns, why do I still pick stocks? Because, well, hi, my name is Joseph and I'm an addict. You see, I, like a lot of you out there, love following the stock market. It goes beyond just a gambler's addiction or trying to beat the market. This is something I love doing. I have ever since I got my first share of Comtron stock when I was 10 years old. And the problem is, even though I know the easiest, the best way to invest it is just buying those index funds to be the market rather than try to beat the market, I will always follow the market and pick individual stocks. And so here's where that gets dangerous. If I try to force myself to just invest across index funds, that urge to follow stocks has me jumping in and out and making all those bad decisions with those long-term investments. Now, I, like so many investors, just get in my own way. So here, I've found a way to limit how much damage I can do to my own financial goals while still being able to scratch that itch, following the stocks, and reach for that extra return. That solution is to invest most of my money across 3 to 5 exchange-traded funds like the ones in this video. By investing across index funds and other themes, I get broad market returns that meet my goal. Then with maybe 15 or 20% of my portfolio, I can invest in those individual stocks. I can follow the market, enjoy analyzing the stocks, and since it's only a small portion of my portfolio, knowing that I'm not going to derail my financial future. And the best part about this strategy is it's totally customizable for your goals. You can play around with how much you invest in those funds versus the stocks, and even how much you invest in each fund. For example, out of our 3 funds, I would go with maybe 65% in that stock fund, 25% in real estate, and 10% in the bond fund for a weighted return of 13% annually. Our 3rd fund is the Fidelity Total Bond ETF. That's ticker FBND with a 0.36% expense ratio and a 3.8% dividend yield. Now, I'm including this one just to round out our list of Fidelity portfolio, but this is one where I think you could probably use a different fund, maybe like the Vanguard Long-Term Bond ETF. That's ticker BLV. Nation, there is no reason to pay a 0.36% expense ratio on a bond fund, especially when there are other funds like this Vanguard one that is charging just 0.07% and paying a comparable dividend yield. Now with the Fidelity Fund, you do get a nice mix of bonds with just under 40% in that super safe US government bonds category, and the rest mostly in corporate and mortgage bonds. Now what's really interesting here though is of the two bond funds, the Fidelity Fund and the Vanguard, have traded places so frequently on performance. Usually index funds track each other fairly close, but you can see here the Vanguard fund outperformed for about 2 years, then has dropped much harder in the bond market sell-off this year. All in all, the Fidelity Fund has produced a solid 2% annualized return and helped protect your money since inception. Click on the video to the right for a step-by-step to picking an ETF fund and the 3 best ETFs every investor should buy. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.